Hey, I'm Gio.
And I'm Oscar.
This is The Come Up. Today we're going to talk about stocks, what they are, and how they make you money.
And stick around till the end because we have some bonus content for you on what apps you can use to buy stocks. So in this video, we'll be talking about a few different things, including why do companies sell stock, how do stocks make money for you, can I lose money in stocks, among other things.
We are not financial advisors. We mentioned a few stocks as examples, but we are not telling you to buy or not buy that stock. That is a decision that you have to make. This information is for entertainment and informational purposes only.
So what are stocks? Well, a stock is just a small piece of ownership in a company. So imagine that Gio and I started a company, like the Come Up or whatever, and we have each one share in the company. Okay, so we have split ownership, 50%, one share each. Well, the difference between a small company like us and Apple is that Apple has millions of shares out there that are owned by people all over.
So why do companies sell stock? Companies that are looking to invest in new product lines or they want to expand into new locations, they need a way to raise funds. And they have multiple options to do that. One of them would be going to the bank and getting a loan. They have other options as well, but one of them is going to be selling stock to the public. Starbucks in 1992 issued their first stock to the public, and at that time they only had about 165 stores nationwide, and they went ahead and issued the stock and raised a lot of money. And with that, over time they have grown to having over 33,000 stores worldwide.
When I buy a stock, what am I getting? Well, back in the days, you actually got a physical certificate that showed proof of ownership in the stock of a company. However, today everything's digital, so you no longer get a certificate. You can actually just check how much you own using an app.
So how and when does a stock earn money for me? We're going to use two different examples because there are two different ways. So appreciation is going to be when the value of the stock itself goes up. Pretend that you own Apple stock and Apple has been selling a lot of iPhones. The profits from those iPhones are reinvested into the development of a new iPhone or a new MacBook or new software. That then leads to more people wanting to buy their products. As they sell more of their products and reinvest more into themselves, the value of that company goes up. So if you have held your small piece of ownership in Apple, it has been going up as they create new iPhones and new products in general. When someone else wants to buy into Apple, you can then sell your share for a higher amount than when you bought it, because you bought it before the most recent set of products that they've developed. That is what appreciation is. On the other hand, you have dividends. So take a company like Coca-Cola. If you own shares of Coca-Cola, they will take their profits and before reinvesting, first they share those profits with their shareholders, which is you, in the form of what's called a dividend. So if you own a share of Coca-Cola, you get a small cut of the profits from the previous quarter. Those would be the two different ways that you are going to earn money with the stock that you own. You get your money. She's back?
Yeah.
Oh, wow.
As far as when you get those gains, what matters is when you buy and when you sell. So ideally, you want to buy a company and hold it long enough so that there's time for the company to sell more products, grow in value. And so if you hold for, say, 5 years, 10 years, more time that it has for the stock to grow and for the company to grow. Can I lose money by investing in stocks? Is it gambling? In short answer, there is risk involved. However, it is different from gambling, because if you go into the casino and you go to the roulette table and you put it, $500 down on red, you have the possibility of losing that in an instant. However, when you invest in a company like Apple, you're taking a calculated risk that the company will continue to sell products and continue to innovate and continue the track record that they have being a successful company. The thing that you have to keep in mind is you want to keep the long-term view in mind, because think about Chipotle. We talked about them in one of our earlier episodes, and they had this E. coli situation, and what happened to their stock? It took a big dip. And what happens if you sold during that dip? Well, if you sold, then you could have taken a loss, but if you had not sold, if you had held, then you would have went on to reap the phenomenal gains that Chipotle has had since then. And I mean phenomenal. They just blew it out of the water. So that is, the difference between gambling and taking a calculated risk. What about real estate? Is that a better investment than buying a stock? Well, they're just different vehicles, and they have different advantages to them depending on what you like. So one advantage of, say, a stock over buying a piece of real estate is that it is liquid. And what that means is that you can buy and sell a stock more easily than buying and selling a property, which takes more time. You got to have an agent and list it up and make it pretty, make renovations, things like that. I'll speak for real estate a little bit. It can be a ludicrous, what's the word? Lucrative. Ludicrous.
It could be ludicrously lucrative.
Isn't ludicrous as a word outrageous?
It is a word as well, yeah.
Yeah.
It's outrageous.
Okay.
Should
I say it could be ludicrous? I mean lucrative.
Ludicrously, wait, what's the word again?
Ludicrously lucrative.
Ludicrously lucrative.
Okay. So that's not to say that real estate is not a good investment. Real estate can be a tremendous way to grow your money. It's just, it tends to take more work. You got to take the time, you need the capital, you need usually lots of money to buy up real estate, whereas a stock you can usually buy, especially now they've made it so easier. You can buy what's called fractional shares, so you don't have to buy a whole stock. You can buy a quarter of a stock or less. So it just makes it easier for you to buy with $100 just to start trying it out and get a feel for it. So they're just different vehicles, and I do both. Another thing to consider is that you can actually buy stock in something called a REIT, which is essentially a company that invests in real estate, and then you can get the gains that way and benefit from having that liquidity. If you've enjoyed this content, if you find it valuable, please hit the like, subscribe, notification bell, comment, all that good stuff, because it gives us a little encouragement to keep making more of these videos.
So now that you've watched this far, first of all, thank you. And we're going to give you a little bit of a bonus, which is we're going to talk about the platforms that we like to personally use for our own investing. I like to use a platform called M1 Finance, and there are two big reasons why I like to use that. Number one, they allow you to buy what are called fractional shares. All a fractional share means is that, for example, right now Amazon is worth over $3,000 per share, but I don't need to save up $3,000 to invest in Amazon. I can do a smaller percentage of that, and they'll just give me a fractional share. The other reason that I like M1 Finance is they allow you to create what are called pies. A pie is just a grouping that you can create yourself. Like me, for example, I have a technology pie where, say I put $500 into my technology pie, and it'll split that into a number of different technology companies that I have chosen to put in that pie. And that's why I like M1 Finance.
And you can set the proportions for the pie?
You can set the proportions. So
nice.
I tend to favor Microsoft over Apple. So more money goes into my Microsoft stocks than Apple.
And you can probably automate that, right? So that
I do. Every paycheck I send some money.
Very nice. So I've used Robinhood, Fidelity. Actually, I've used others as well, but today I mostly use Fidelity, and I also got into that one for the same reason as Geo, because they were one of the early ones to offer fractional shares, which makes it more affordable for you, as Geo was mentioning. Now it's pretty common. I think almost all now provide a no cost buying and selling, which is nice.
In the description, we're going to leave some referral links that have a bonus for you and a bonus for, there will be a bonus for ourselves as well. Each platform has their own bonus and terms and conditions. So you'll need to see within each link what those are. But each one will have a bonus for you if you sign up using that link.
To wrap it up, if you don't have the time to be researching a lot for one company, or you're worried about the risks, then you can mitigate some of that risk by choosing instead an index fund. Like the S&P 500 is a popular one. It's called 500 because it's got 500 different companies in it. And so you're diversifying, but you're spreading the risk by investing in this many companies, because chances are more of them are going to do well than the ones that are not. The biggest bulk of my investments are in index funds.
Thank you for getting this far. I think we're going to create another video in the future about index funds. But thank you for watching this one. See you next week.
See you next week. Valid feedback.
Yeah.
Was that you or was that the chip?